Welcome to module 10, which is more or less going to delve into the forecasting of income statement and different aspects of forecasting income statement. In the previous module, we have had discussions pertaining to the financial forecasting in general, and we discussed different aspects, say significance, usefulness and the limitations, as well as different methods which are related to forecasting. But we all know that when we are going to talk about the users community or the stakeholders in general, they are more or less inclined to access the financial information through the financial statements. But the companies normally disclose financial states of affairs through financial statements related to the activities which had already been done. Essentially, if the users community are going to get access to the financial statements disseminated by the corporate world, they are more or less into a retrospective analysis of the financial states of affairs of a company. But for the purpose of financial decision making, it is imperative on the part of the users community to have an idea and exposure to what is going to happen in terms of financial states of affairs pertaining to the corporate world in general. So, this particular module is going to address one of the most fundamental document which is falling under the purview of financial statement, namely the income statement and its projection. Moving further, when you are going to talk about projected income statement or forecasted income statement, essentially we are going to predict the operating result of a corporate entity owing to the simple reason that the financial variables which are finding a place within the ambit of income statement more or less addresses the operating activities which are getting executed in the business, and at the same time different non-operating expenses and incomes are also shown in the financial statement, namely the income statement. So, when we are going to talk about projection of income statement, obviously we are there to predict all the financial items which are normally disclosed in the income statement, and here is a brief introduction to the projected income statement. Projecting a company's future financial performance over a given time frame, may it be monthly, may it be quarterly, may it be annually, is the process of creating a predicted income statement. It assists companies with cash flow management, growth planning and communicating financial expectations to stakeholders. Now, the very purpose of preparing income statement is to provide lucid information with regard to the profitability of the company, but at the same time we all know that the profitability information is ultimately leading to check out different policies and plans which are going to contribute towards the growth and strategic orientation of a business. So, it is a dire necessity on the part of the users community to get access to income statement and if possible to project the income statement so that they can get into the future orientation of the buddy corporate and they are in a position to take informed and rational decisions with regard to their vested objectives. Moving further, when you are going to talk about the projected income statement, there are different components which are normally disclosed while preparing the income statement. The income statement addresses both the dimensions of the business, namely the revenue, which is otherwise interpreted as the income of the business, and on the contrary the expenses which are incurred by a company in lieu of performing different activities related to different functional domains of a business. So, to start with, the income statement is normally starting with the revenue disclosure in lieu of the sales activities which are getting executed in the business. So, in the projected income statement, also we are going to start from the same by projecting the sales considering different market sensitive variables, different conditions, different seasonalities and fluctuations which are macro in nature, more or less external to the business, and at the same time we are also there to keep an eye on the internal movements with regard to resource utilization, with regard to application of additional assets and so on and so forth, so that we will be able to predict the sales revenue in a cogent manner. Moving further, when you are going to talk about the expenses side, it starts with cost of goods sold, and cost of goods sold is normally the sum accumulation of all the expenses incurred to manufacture the product and make it to the point of sales so as to arrive at the operating income at the end of the business. But there are different orientations when you are going to talk about the forecasting or the prediction of cost of goods sold, because there are different methods of predicting the income statement, and different methods have different logics, different orientations to predict different components of the income statement. So, say for example, the most simplest method of predicting income statement is percentage of sales method. So, under this method we are there to address the cost of goods sold as a percentage of the sales based on the past information. So, that is one of the simplest way, and we will be delving into different other methods of projecting income statement and projecting different variables which are falling under the purview of income statement down the line in subsequent lectures which follows this one. Then moving further, when you are going to talk about the difference of sales revenue and cost of goods sold, we are arriving at the gross profit, which is the difference or the excess of revenue generated over and above the cost of goods sold. Then after calculating the cost of goods sold, and we are there to predict the operating expenses. Now, when you are going to talk about operating expenses, there prevails two different aspects of operating expenses, namely the variable expenses and the fixed expenses, and the income statement accommodates both. When you are going to talk about variable operating expenses, that simply refers to those expenses which are directly proportional to cost of goods sold or to sales activities. Say for example, when you are going to talk about the maintenance activities or the recurring activities, say salaries, obviously the salary is a variable component owing to the simple reason that if you are there to magnify the quantum of production, we are there to increase the number of laborers which are going to be engaged. So, we are there to pay higher salaries in lieu of the additional employees who are more or less engaged in magnifying the production activities. So, there are many examples of variable expenses which are falling under the purview of operating expenses in general, but on the contrary there are also different expenses which are fixed in nature, which is not going to change with changes in the level of output or volume of production or volume of sales. Simply say for example, when you are going to talk about the interest costs, the interest cost is a financing cost which is not going to change. So, there are many examples like depreciations like rent. It is also one of the fixed expenses, because whether you produce 0 or you produce up to a maximum capacity, the rent in lieu of the building or the infrastructure which a particular corporate is using is not going to change. Rather, it is fixed and it is leading to fixed financial obligation at the end of the company. So, that is why when you are going to talk about operating expenses, we are there to make a note of different expenses which are falling under the purview of operating expenses. Then moving further, after calculating the operating expenses and predicting it based on the past performances, we are there to calculate the operating profit, which is more popularly known as operating profit before interest and taxes. Now, after calculating operating profit, we are there to offset that revenue against all those expenses which are more or less falling under the purview of financing cost. Now, here there may be different types of financing costs depending upon the capital structure through which the company is capitalized or the company is applying the funds by consuming both the internal and external sources of fund. Now, after offsetting all these expenses, we are there to deduct the mandatory liability, which is tax that is going to be levied on the net revenue generated in the form of income at the end of the company. So, doing the same, we will arrive at net income, and when you are going to talk about prediction of income statement, here I have made a mention of few variables which are normally disclosed in the income statement, and each and every financial variable which are finding a place in the income statement are to be forecasted or predicted by using different methods which are made available. So, for example, we can go for percentage of sale method, we can go for trend analysis, we can go for time series modeling, we can go for statistical analysis, we can go for sensitivity and scenario analysis, and so on and so forth. There are many variants of methods available to predict all these items, and each and every method is having their advantages as well as their impediments. So, it is up to the company, and at the same time it is up to the users community to predict the different variables which are finding a place within the ambit of income statement to predict to the best of their accuracy. Moving further, when you are going to talk about the projected income statement, what objectives it is going to serve at the end of the users community, both internal users and external users, because the company professionals, the internal users are equally inclined to know what is going to happen with regard to the operating activities of the business down the line, at least in the near future, and at the same time the external users are also equally interested to know what is going to happen with regard to the profit making ability of a body corporate down the line in the short span of future. So, moving further, when you are going to talk about objectives of projected income statement, here I have made a mention of some of the formidable objectives. It is leading to performance benchmarks. It sets performance standards and trade-offs with actuals. Obviously, when you are going to talk about the projected income statement, obviously we are digging out the financial performance in terms of operations, whether the company is sufficiently generating excess revenue to be distributed to the stakeholders or not after meeting all its expenses during a particular financial year. Now, we are there to compare the same with the peers or the industry standards in order to fix or specify a benchmark to which we are always inclined to accomplish the same through our operating activities. And at the same time, when you are going to talk about budgeting, when you are going to talk about financial planning, we are also there to compare what we have projected and what we achieved as actual operational outcome. So, by having a trade-off between actuals to that of the forecasted figure, we can dig out the areas of deficiencies, and at the same time, by knowing where we are lagging in terms of operations, we can take necessary measures to come out of all those deficiencies and to improve upon the operational performance of the business. Moving further, it leads to financial planning and budgeting, facilitate estimation of future revenues, expenses and profits, and efficient allocation of resources. Because when you are going to talk about forecasting operational performance, it is contributing significantly to financial planning and resource allocation, because by doing so, we are in a position to dig out those areas or those activities which are not contributing significantly to the very objective of optimization of profit. So, we should withdraw the resources which are committed to those activities, and we are there to divert those resources to other lucrative activities which are significantly capable of contributing in a favorable way towards the objective of profit optimization. So, it is not only facilitating the financial planning, rather at the same time it also facilitates the body corporates to efficiently allocate resources in the most productive activities, which is going to contribute significantly to the very objective of the business. Moving further, it also facilitates strategic planning, executes decisions on new product introductions, market enlargement and pricing. Because when you are going to talk about the appraisal of profit potential, obviously it is conditional upon many different factors. Some are external to the business, some are internal to the business. But if a company is, after prediction, having the information that the sales are going to decline down the line, they may think of introducing a new product to their existing line of products to magnify the overall revenue generated from sales activities. At the same time, if the market is getting saturated with regard to the existing product, we may go for searching other markets or other avenues so that we would be able to generate our targeted revenue in spite of the fact that in a particular market our product is getting saturated. Similarly, at the same time, when we are facing stiff competition in the market, obviously we all know that so far as sales are concerned, it is heavily influenced by the price as one of the formidable variable, and it is taken up by the consumers community with severity. So, if there prevails price war in the market, what should be done so that the pricing would be legitimate and competitive so that we can have an edge over the peers and the competitors in general. Moving further, it also facilitates investment decision making, facilitates investors and stakeholders in appraising the company's expected profitability. Obviously, when we are disseminating the financial statement, whether it is income statement or balance sheet, the very essence and the objective of dissemination of financial statement may be related to the actual facts and figures or it is related to the projected orientation. It serves the fundamental purpose at the end of the investors to provide information with regard to the profit making ability of the business. And investors are very much concerned about the aspect of ability to which the companies are capable of so far as their profit generation is concerned. If a particular company is having higher capability to generate profit, obviously that company is going to attract more potential investors and the company is going to mobilize capital in a better way from the market compared to a particular company who is having lower potential to generate profit down the line in the near future. Moving further, the last one is proactive risk management. It facilitates the identification of potential shortfalls in revenue or profit and facilitates sensitivity analysis. We all know that the operating performance, the so-called profit generation and the ability of a company to generate profit, it is conditional upon different factors external and internal to the business. But the companies are there to conduct and convene their operating activities within the business ecosystem owing to the simple reason that they cannot exercise any control over the external factors which are going to have a bearing on the profit potential of the business. So, if something is going wrong at the end of the company or some unfavorable consequences are expected to be there in the near future to which the company is having an exposure, obviously that is one of the operating risks to which the company is exposed to. And by having proactive information with regard to all these things, the company may check out to mitigate that operating risk to which a company is exposed to. And projected income statement contributes heavily towards that proactive approach adopted by companies so far as operating risk and its mitigation is concerned. Moving further, when you are going to talk about the usefulness of projected income statement. In the previous slide, we have discussed and debated about the objectives, the formidable ones. There are many objectives and the formidable ones have been discussed. Now moving further, the usefulness, it can contribute to the internal users, the external users in general in many different ways through the preparation of projected income statement. To start with, it leads to rational decision making, offers data driven insights to support operational and strategic decisions. We all know that the decisions are not going to be taken by the machines or the infrastructures, rather the decisions are going to be taken up by the managers or the people who are held responsible for the said act. Now, always it is experienced in the corporate world that in the protocol of executing decisions, the managers are carried away by their ego, carried away by their hunches, carried away by their prejudice when they are resorting to the task of decision making, paying no attention to the data. But if the projected income statement is made available to all the managers, obviously they are more inclined to take their decisions rationally by basing their decisions on the data rather than carrying the decisions backed by their own hunches or desires. So, the projected income statement facilitates rational and informed decision making so far as the general stakeholders are concerned. Moving further, it leads to cost management, alignment of spending with expected revenue, enabling effective budgeting and cost control. Now, we all know that in a business, whatever we spend, whatever activity we are there going to take up, we are there to consider in what way it is going to contribute towards the business. In other words, we may say that if we are spending, say for example, there is an activity X and we are spending rupees P. Now, we are there to dig out before committing that P in activity X whether the revenue generated out of the activity X is more than P or not. Now, if it is less than P, then it is not worthwhile to take that activity X, owing to the simple reason that the benefit deduced from that particular activity is less compared to the resources committed in performing that activity. So, through alignment of revenues and cost, we would be able to dig out those activities which are not contributing, rather in a general sense we may say those activities which are not that serious and which are not so concerned so far as contribution to the very objective of profit optimization is concerned, and we can scratch all those activities or we can drop all those activities from the operating orientation, so that we would be able to make the operating performance better off down the line in a future span of time. So, it leads to cost management owing to the simple reason that we are having pre-hand information with regard to different costs associated with the performance of different activities. So, that is more or less facilitating all the stakeholders community to go for cost management. When you are going to talk about cost management, it starts with cost reduction, then it further moves to cost control, then it leads to cost management. Cost reduction is not always practically viable owing to the simple reason that if a company is performing to the best of their level of efficiency, then there is no possibility of any cost reduction because the cost is optimum. So, there is no probability or possibility of reducing the cost further. So, in that case we are there to exercise cost control, but again all the possible orientation does not lead to cost control, because you can only exercise control provided a particular occurrence is happening and it is within your control. As I said in the beginning that the operating performance, which is measured through income statement, are exposed to both external and internal factors. So far as internal factors are concerned, it is within the ambit of control. But if the cost is magnifying as a consequence to one external factor which is emanating from the market pervasive forces, we cannot exercise any control over that. We can only manage the cost. So it facilitates that. Then goal setting and performance, monitoring specifications of targets and comparison. It leads to goal setting and performance owing to the simple reason that the moment we are having pre-hand information with regard to revenues, with regard to cost of goods sold, with regard to operating expenses, with regard to financing cost, we can pre-specify the targets, and we are more or less devising our activities in such a manner so that we are there to achieve our goals. Next, moving further, it leads to prospective assessment of profitability. Obviously, when you are going to talk about prospective assessment of profitability, it leads to the simple orientation of the profit to be accomplished in a future span of time. Then moving further, it facilitates or it contributes towards investor confidence. It is one of the direct outcome of projected income statement, owing to the simple fact that investors are always inclined towards those companies whose profit making ability down the line in the near future is absolutely robust and in a favorable orientation, and investors are always ahead in terms of committing their capital through their investment activities in those companies who are disclosing higher profit potential down the line in the near future. Moving further, it leads to robust resource allocation. There are many activities which are related to the operations of a business where the allocation of resources may be suboptimal, which was experienced in the past. But by projecting different activities and the cost in lieu of those activities, obviously we would be in a position to know in what activities the resource utilization is suboptimal and it is subdued. It is not contributing towards the profit making potential of the business. So we can diversify those resources to productive orientations, and thereby we can achieve the very objective of optimum resource allocation and making the resource allocation robust. Moving further, the last one, it is also leading to scenario analysis. It foresees the impact of changes in variables on profit. Obviously, when you are going to talk about scenario and sensitivity analysis, we are more or less addressing the macroeconomic factors, say the increase in national income, then the increase in GDP, then the decrease in inflation. They are market pervasive forces, and obviously each and every company is exposed to such macroeconomic movements, and their profit down the line in a future span of time is conditional upon changes in those market pervasive forces. And by having a projected income statement, we can delve into these issues in an appropriate manner. Then there comes the limitations. Though the income statement contributes very heavily towards optimization of profit at the end of the company and facilitating the external users, the stakeholders community in general, to execute their financial decisions in a rational and informed manner, the projected income statement is not free from fallacies. There prevails some impediments to which the projected income statement is highly exposed to. Here I have made a mention of some of the formidable limitations, uncertainty and assumptions. Obviously, when you are going to delve into future is surrounded by uncertain events, uncertain situations and uncertain conditions, and when we are predicting it, obviously we are falling easy prey to all those uncertainties, and whenever we are going to have different predictions, we are carrying certain underlying assumptions, and all our predictions are based on such underlying assumptions, and it is highly exposed to uncertainties and assumptions. Then there comes erroneous or incomplete data. The past information is more or less utilized when we are talking about the projection of income statement. If the past information is faulty and it is incomplete, obviously we are in an unfavorable orientation so far as the projection of different financial variables to be disclosed in the income statement. Moving further, external issues. As I said, external issues are beyond the purview of the control of the management of the company. So, we are easily exposed to movements or vulnerabilities encountered in all sorts of external issues, may it be economic, social, political or cross national. Moving further, we are going to talk about projection of income statement. Sometimes the persons who are behind the screen, those who are doing these projection activities, they may be carried away by the act of over optimism. They fail to see to the negativities, rather they are more into the positive orientations. Then always projected income statement is short sighted, it can only address the short run orientation. And the last one is the intricacy in dynamic industries, those industries which are highly vulnerable and changeable in nature. It is very difficult to arrive at projections of different variables which are falling under the purview of income statement. So that is why it works, the projection of income statement works favorably and in a stable manner, provided the industry is behaving in a perpetual orientation and in a stable way. But in case of unstable industries, it is very difficult to project income statement, and if we are trying to do so, we are exposed to high level of imperfections. Now, that is all about this particular lecture, which more or less discussed and touched upon different aspects of projected financial income statements, the objectives, then the usefulness in general so far as the projection of income statement is concerned. Thank you for your patient hearing.